Right now, somewhere in your bank account, there is money just sitting there, not doing anything, not growing, not shrinking, just waiting, and you have a choice to make about it. A choice most people get in the wrong order. Here's the strange part. It's not how much money you have that decides whether you retire rich or retire broke. It's the order you move it in. Get the order wrong, and you can lose tens of thousands of dollars without ever making a single bad investment. So here's the question we're going to answer today. What is the exact order, step by step, that turns a normal paycheck into real wealth? By the end of this video, you'll know the full sequence, and you'll understand the one step almost everyone skips, the one that quietly costs people more money than any stock market crash ever could. Let's start with why order even matters. Your brain treats money decisions like a to-do list. Pay some bills, save a little, maybe invest a little. Whatever feels most urgent gets done first. That feels responsible. It is not. Richard Thaler, an economist who studies how people actually behave with money instead of how they should behave, calls this mental accounting. It means your brain sorts money into separate mental buckets, like a vacation fund, a bill fund, a fun money fund, instead of treating it as one connected system. That sounds harmless. It is not. Mental accounting is why people carry a credit card balance, charging 20% interest, while also putting money into a savings account earning less than 1%. Two buckets, two decisions that don't talk to each other, and it quietly bleeds you dry. The fix isn't willpower. It's a fixed order. A checklist your brain follows every single time money hits your account, so you never have to decide in the moment. Decide once, repeat forever. That's what we're building today, step by step, in the exact order that protects you first, grows you second, and multiplies you third. Step 1. Before you save a single dollar anywhere else, check if your employer offers a retirement match. Here's what that means in plain terms. Some companies will add extra money to your retirement account, but only if you put money in first. If your company matches 50% of what you contribute, up to a certain amount, that is an instant 50% return on your money before the market even moves, before you pick a single investment. Nowhere else in your entire financial life will you find a guaranteed 50% return on day one. Not stocks, not real estate, not crypto, nothing. And yet millions of people leave this money on the table every single year. Why would someone turn down free money? Shlomo Bernatzi, a researcher who studies retirement saving, found the answer isn't laziness, it's inertia. Humans are wired to stick with whatever requires the least action right now, even when the future cost is enormous. Bernatzi helped design a program called Save More Tomorrow, which automatically increases how much people save from every future raise, so they never have to make an active decision to save more. Just by removing the moment of choice, savings rates went up dramatically. That tells you something important. Willpower isn't the problem. Friction is. So step 1 is simple. Find out if your job offers a match. If it does, contribute at least enough to get the full match. Every dollar you skip here is a dollar you are choosing not to be given. Now here's where most advice gets it wrong. Most people are told, after the match, go straight into investing everything else. Don't. Not yet. There's a step in between that almost nobody talks about, and skipping it is the single most expensive mistake on this entire list. Step 2. High interest debt. Specifically, anything charging above roughly 7 or 8% interest. Credit cards, some personal loans, certain car loans. This is debt that grows faster than almost any safe investment can realistically outrun. Here's the math nobody explains clearly. If your credit card charges 22% interest, and you're also investing in the stock market hoping to average maybe 8 to 10% a year, you are guaranteed to lose that race. Every year, you are paying 22% to owe money while earning far less to grow money. That gap doesn't shrink, it compounds against you. Why do so many people invest anyway, even while carrying expensive debt? This is where Daniel Kahneman and Amos Tversky's research becomes useful. They studied how people make decisions involving risk and found something called loss aversion. It means losing money feels roughly twice as painful as gaining the same amount feels good. Paying off debt doesn't feel like a win. There's no dopamine hit, nothing lights up. It feels like giving money away with nothing to show for it. But investing feels like building something, like growth, like hope. So people chase the feeling of growth while quietly bleeding money to debt in the background. It's not stupidity, it's a feeling problem, not a math problem. Here's the reframe. Paying off a credit card charging 22% interest is not boring. It is a guaranteed 22% return. Guaranteed. No stock has ever promised you that. Once you see that payoff as an investment instead of a punishment, the order starts to make sense. So the sequence so far: grab the free match. Then aim every extra dollar at high interest debt until it's gone. Quick pause here, because you're probably wondering about something specific. What about an emergency fund? Shouldn't that come first before anything else? Good question. Here's the honest answer. A small starter emergency fund, something like $500 to $1,000, should exist before you attack debt aggressively. Not a full emergency fund, just enough so one flat tire or one broken phone doesn't send you right back onto a credit card, undoing all your progress. Think of it as a shock absorber, not a safety net yet. The full safety net comes next. Step 3. Build your real emergency fund. 3 to 6 months of essential expenses, sitting somewhere safe and easy to access, not invested in the stock market. Why does this come before serious investing? Because the market doesn't wait for your convenience. Robert Shiller, an economist who has spent decades studying market behavior, has shown that markets swing far more than the actual economy justifies, driven heavily by emotion and crowd psychology rather than pure logic. Translation: markets can drop hard and fast and at the worst possible moment. If your only savings are sitting in the stock market and you lose your job during a downturn, you may be forced to sell your investments at a loss just to cover rent. That single moment can undo years of careful investing. An emergency fund isn't there to make you money. It's there so a bad month in the economy never becomes a bad decade in your portfolio. It's the buffer that lets you leave your investments alone when everything else is falling apart. Here's something that might surprise you. This step is also a psychology fix, not just a math fix. Research on financial anxiety consistently shows that people with even a modest cash cushion report significantly lower stress about money, even when their income hasn't changed at all. Same paycheck, same bills, less fear, just because there's a buffer. That's not a coincidence. Your brain evolved during a time when running out of resources could genuinely threaten survival. An empty cushion still triggers something ancient in you, even when your actual risk today is a late credit card payment, not a famine. The emergency fund comes a system that's reacting to a threat from thousands of years ago. Okay, free match secured. High interest debt gone. Emergency fund built. Now finally it's time to invest seriously. And this is where most people make their second biggest mistake. Not picking bad investments, picking the wrong account. Step 4. Tax advantage retirement accounts. Specifically, finish maxing out that employer plan and strongly consider a Roth IRA if you qualify for one. Here's the plain English version of what that means. A Roth IRA is a retirement account where you pay taxes on the money now, while it's a smaller amount, so that decades later, every dollar of growth comes out completely tax-free. Not taxed less, not taxed later, tax-free forever. Why does the order matter here specifically? Because of something called compound interest, which just means your money earns returns, and then those returns start earning their own returns, snowballing over time. Compound interest needs one thing above everything else to work its magic: time. Not luck, not a hot stock pick, time. Every year you delay stepping into a tax-advantaged account is a year of compounding you can never get back. Not next year, not ever. It's gone. Mia Statman, a researcher in behavioral finance, has spent years studying why people treat money the way they do, and one consistent finding is that humans are wired to overvalue the present and undervalue the future. A dollar today feels more real than a dollar in 30 years, even when the math says that future dollar grown for 3 decades is worth dramatically more. Your brain is bad at feeling the future. That's exactly why the order matters so much here. If you wait until it feels convenient, you will wait too long every single time. So the order isn't just about avoiding fees or maximizing tax breaks. It's about beating a bias built directly into how your brain values time. Quick pattern interrupt before we go further, because there's a detail coming up in the next step that almost nobody outside of finance even knows exists. If you have access to it, it might be the single most powerful account on this entire list, more powerful than the Roth IRA you just heard about. Step 5. The Health Savings Account, or HSA, if you have access to a high deductible health insurance plan. Here's why this account is so unusually strong. Most accounts give you one tax break. Put money in, get a break now, or take money out tax-free later. Pick one. The HSA gives you both. Money goes in tax-free, it grows tax-free, and if you use it for medical expenses, even decades from now, it comes out tax-free too. Triple tax advantage. There's no other account like it. Here's the part almost nobody knows. You don't have to spend it on medical bills right away. You can let it sit and grow for 30 years, then use it in retirement, when medical costs tend to be highest anyway. It functions like a secret retirement account wearing a disguise. Why does it come after the Roth IRA in the order instead of before? Mostly because not everyone has access to one, since it requires a specific type of health plan. But if you do have access to it, don't sleep on it. This is the step people skip simply because nobody ever explained it to them clearly. Step 6. A regular taxable brokerage account. This is what most people picture when they think of investing. No special tax advantages, no contribution limits, just you putting money into low-cost, broadly diversified index funds. Let's define that plainly. An index fund is a single investment that automatically spreads your money across hundreds or even thousands of different companies at once, instead of betting on just one. Why does that matter so much? Harry Markowitz, an economist whose work laid the foundation for modern portfolio theory, showed mathematically that spreading your money across many different investments reduces your risk without necessarily reducing your expected return. In plain terms, diversification is one of the only strategies in investing that gives you something for nothing. Less risk, same potential growth. This is where people start to get tempted by something else though. Individual stock picking, trying to guess the next big winner. Here's the uncomfortable truth. Study after study on investor behavior shows that most people who try to beat the market by picking individual stocks end up underperforming a simple, boring index fund over the long run. Not because they're not smart, because trying to time the market and pick winners introduces exactly the kind of emotional decision-making that Kahneman and Tversky's research warns about. Fear during a crash, greed during a boom, buying high, selling low, again and again, without even realizing it's happening. Step 6 isn't exciting, it's not supposed to be. Boring, consistent, low-cost investing is one of the few strategies that has reliably built real wealth for regular people over decades. We are almost at the end of the order, but there's one more step, and it's not about money at all, it's about you. Step 7. Stay invested. Ignore the noise. Let time do the work. This might be the hardest step of all, not because it requires effort, but because it requires the opposite. Doing nothing on purpose while your brain is screaming at you to do something. Every time the market drops, headlines get louder. Fear spreads fast, because fear kept our ancestors alive when threats were physical. A falling stock chart doesn't actually threaten your survival the way a predator once did, but your nervous system doesn't fully know the difference. It reacts anyway. Dan Ariely, a researcher who studies why people make irrational financial decisions, has shown repeatedly that emotional, in-the-moment choices tend to be worse than decisions made calmly in advance before emotions take over. That's exactly why the order we just built matters so much. You're not deciding what to do during a crisis, you already decided. Match first, debt second, emergency fund third, tax advantage accounts fourth, HSA fifth, index funds sixth, and then step 7, You simply hold the line. So let's bring this back to the beginning. Remember that question from the start? What decides whether you retire rich or retire broke? It was never really about how much you earn. Plenty of high earners retire with nothing because they invested out of order, chasing excitement instead of following a sequence. And plenty of average earners retire comfortably simply because they followed the order patiently for decades without needing to be a genius about it. The order is the strategy, match, debt, emergency fund, tax advantage accounts, HSA, index funds, time. So here's the only real decision left. The next time money lands in your account, will you let your brain sort it into random buckets, reacting to whatever feels urgent in the moment? Or will you follow the order, the same 7 steps every single time, until it's no longer a decision at all, just a habit that quietly makes you wealthy while you're busy living your life? There's still money sitting in your account right now. It's still waiting. This time you know exactly what to do with it.